Welcome to Differentiated Understanding. What do I mean by this? Well, in a world where there is no longer a massive barrier for obtaining information, diverse knowledge and perspectives are no longer rare. What makes an insight or a way of doing things unique is differentiated understanding. Piecing together scattered information, parsing through noise and clouds, and then succinctly coming up with your own understanding of the situation, event, business, or person. That is what is truly valuable. Every episode, we bring in a special guest to talk about their unique take on a critical matter, phenomenon, or business trend. But most importantly, someone who will offer thoughtful thinking. Hi, everyone. This is Grace Shao. Joining me today is Kevin Zhang. Kevin is an investor at a family office where he leads AI investments across asset classes. His career has spanned roles as a venture capitalist, startup founder, and software engineer, with experiences in both Silicon Valley and New York, and before moving to Asia. So he's now based in Asia. He brings deep technical and product expertise across domains from machine learning to enterprise software. And in his spare time, Kevin writes a blog on Substack called East Wind. Go check it out. It's focused on technology investing. So Kevin, thanks so much for joining us today.
Hi, great. Pleasure to be here.
Yeah, tell us about yourself. You've had quite a journey, from Silicon Valley and now into you're based in Greater China. You've worked as an engineer and now an investor. That's quite unique. Tell us about your professional journey.
Great. So I guess going all the way back to my college days, studied computer engineering both in Canada and then States for grad school, and then spent most of my career in the States in Silicon Valley and New York. So started as an engineer at a company called Salesforce. So they make CRM software before transitioning to a couple of venture funds, one in the Bay Area, one in New York. So primarily the focus has been on early stage software AI investing. And then these days I look primarily at public equities, specifically focusing on the companies that have exposure to AI or businesses who will see a reacceleration of growth because of AI.
Awesome. So we're going to go straight into this. I think we have a lot to cover. First, let's get into the hyperscaler CapEx kind of story. We've been seeing jaw-dropping CapEx commitments, Alphabet raising AI CapEx to $85 billion, Meta committing hundreds of billions, Baba, Tencent, I think over the next couple of years, also committing like $300 billion upwards. It's just these crazy numbers. Do you see this as a necessary investment, or do you think they're absolutely overspending right now and they're creating a bubble?
So I think across the industry, if we look at past technology waves, most famously in the initial tech kind of .com bubble, the industry has overspent, right? But as we zoom out, the spend becomes more normalized and then the demand ends up catching up. And so I think the real question is on a per company basis, right? Whether it's Alphabet, Meta, Azure, with Microsoft, AWS, how much of that is overspending? How much demand can they generate, right, with their whale customers? And then if they end up overspending, how many of these players can survive, right? So for some of the smaller players who are comparatively more leveraged, who don't have the cash flows to support some of the CapEx, right? They're maybe in a little bit more of a dangerous territory than one of the Mag 7, where they're generating a significant cash flow to fund their operations.
I think this kind of goes into also one of your writings recently. You were saying that look, it's all these big tech that are able to afford spending on like LLM training and inference, as well as whatever infrastructure that's needed to really build out sophisticated LLMs. And you said it's basically foundation models are a rich company's game. Why is it the model layer is so capital intensive? And do you think that means we're going to see the startups just kind of in this field kind of just die out one by one, or acquired, or what's trajectory going forward?
I think there are two paths that the industry can take, right? So the default path is if you look at the progression of costs for model training, whether it's pre-training or post-training, each generation has been significantly more expensive, right? So many years ago, it might have been several $100,000, then it went to the millions, tens of millions, hundreds of millions to train a model. So assuming that trend holds, we'll see kind of billion-dollar training runs, right? So taking $1 billion to train, let's say GPT-6 or GPT-7. And so if that is kind of where the world goes, then these companies will need to raise more and more capital to fund their training. They will raise more and more capital to fund their inference, right? So once you train a model, how do you serve it to end users, right? That's also very, very expensive. However, if you're of the view that there will be, or transformers, which is kind of the models that are used in OLM or used in things like ChatGPT these days. If you believe that there will be other model architecture paradigms that are going to be significantly cheaper, then maybe there will be another kind of startup that comes and disrupts the entire business model of an OpenAI or Anthropic or any of these labs.
And was DeepSeek one of those that kind of disrupted the whole model?
I think not necessarily. I think going a little bit into the weeds, their I think $5-6 million final training run touted in their paper. That was only for the final training run, which is not inclusive of the GPUs, right, that they've acquired, their human capital, all the prior training runs and experiments that they've run. And then also within kind of AI training, if you basically train last year's model today, right? It's significantly cheaper than if you want to train a frontier model. And I think Anthropic had a paper or had a blog post where basically for if they want to train a similar model to the DeepSeek R1 a year ago, it would have been 10x more, right? So essentially the costs track, and so it's less so disruptive than I think some of the folks in media might have like thought. And certainly they have made certain like architectural improvements as well as inference improvements at DeepSeek.
So if we use this logic, right, like, does that mean that in the next 3 to 5 years, or even in the longer run, that the CapEx numbers will just continue to climb, or eventually we will see this hyperscaler arms race kind of plateau out a little bit? Because at the end of the day, like, these are already like crazy numbers, right? Like, we're looking at a couple $100 billion put into training in the next 3 to 5 years. That's the plan, but how does one keep up with this kind of money?
Okay, so there's two things, right? There's training and inference. And so on the training side of things, the assumption is labs will continue to require more and more compute to train more and more expensive models, right? So let's say the next model takes 10 billion to train, right? And the model after that takes 50 billion to train. And then theoretically on the training side, that tracks. And then I think where a lot of this CapEx is going, especially if you look at the Mag 7 where they're putting, 70 to 100 billion per year per company. I think a lot of that is the expectation of inference demand, right? So as you put these models to production, whether it's large language models, whether it's recommender systems, image models, video models, that demand will catch up, right? So as it stands, there's a mismatch between the capital outlay into these data centers versus the revenues that Gen AI companies are generating. So if we look at OpenAI, Anthropic, they are the primary beneficiaries in terms of how fast their revenues have grown and the absolute scale or the relative scale of their revenues relative to even companies like Cursor, right, who grew very, very quickly to 500 million in ARR. And so in terms of like software revenues, we're kind of in the tens of billions range, whereas for hardware CapEx or data center CapEx, we're in the hundreds of billions, right? So assuming that software revenues 2 to 3x year over year, then eventually it will catch up to CapEx. If end users, enterprise customers find that they're not getting ROI from these Gen AI apps, then I think that's where the house of cards collapses.
Yeah, actually, let's just like talk about the private market valuation quickly. Like right now, OpenAI is valued at like over 5 billion, Anthropic something like 180 billion, right? Like startups like Cursor, Lovable, chasing billions, or what they're calling $1 trillion ambitions right now. I think the Lovable CEO said they want to become the first $1 trillion business in Europe, right? How should we make sense of these numbers? Like, I'm not a quant person. These just sound like humongous numbers. Like, can you explain this to us? Like how to make sense of this? Like these are just, does it make sense for these companies to be valued at this high in the private market right now?
Yeah, so I think that's a really good question. So the ambition for a frontier lab like OpenAI Anthropic is to be one of the big boys at some point in the future. And so taking OpenAI as an example, right? So if an investor is of the belief that they will eventually build their own cloud, they will get into robotics, their core lines of business, right? ChatGPT as well as their APIs become really large businesses, right? So let's say ChatGPT is embedded in various enterprise kind of customers, and if they're actually able to charge, let's say $200-300 a month, right, as more and more white collar workers uh, are reliant on OpenAI technology, that tracks to a market even in the enterprise side of things, that's several $100 billion, right? And then if you're also of the belief that Google search will be disrupted and Gemini somehow fails to catch up to OpenAI, then they could also run ads on the consumer side of things. Right? So once you add all these kind of lines of businesses together, then optimistic person might see kind of a line of sight to for OpenAI to be this like $3 to $5 trillion company that some of the Mag 7 are at already, are an investor at the 500 billion mark, then I think that's the return profile that you're looking at before kind of taking into account all the dilution from subsequent funding rounds, stock options, etc. And then moving down to the application layer, um, I think these companies are making is if we're able to replace broad swaths of labor and you are able to command pricing that's at some proportion of the ROI that you deliver relative to just replacing like a human headcount, then the exit values for these become enormous, right? So then a cognition at 10 billion might sound really reasonable. I think as the issue right now is the exits will be very spiky, meaning we'll see a lot of zeros and you're going to see a lot of companies really become those 10, $100 trillion companies. And then for a VC fund, you have limited shots on goal. And so as the entry valuations increase, you have less shots on goal. And so on a per investment basis, your risk increases quite a bit.
So in that sense, you don't think we're nearing the ceiling of model layer valuations or anything? Like we haven't hit the peak of the bubble or anything yet?
The markets are definitely frothy, but the winner will be much bigger than we I think originally estimated. And so if you are one of those investors that are in these assets, I think you're going to be fine. If you're not, then I think, which is probably the majority of these funds, I think they're going to be hurt.
So in your writing on Substack, you've argued that, consensus capital is crowding into foundation models, infra, robotics, I think. But, are there areas that you think are underinvested and still in the private market? Like where do you see like overlooked opportunities right now?
I think it's less so maybe overlooked opportunities in AI, right? So like a generalist VC is able to allocate capital across different things, right? So that could be psychedelics, that could be robotics, that could be biotech. And so, or consumer, as we've talked about before. So figuring out kind of what the market dynamics are for those industries where you're just non-consensus enough to be that first check-in, but you're consensus enough that at the next round, whatever you've invested becomes consensus. And this was like the subject of some Twitter debate with Martin at Andreessen, where he was arguing it's not bad to invest in consensus deals because like in the end, like some of these deals end up generating huge returns. And we know that even within AI, like if you're in a consensus bet that pans out, assuming OpenAI is that company, then you're still seeing like a 10x gross return, right? Assuming one of these companies becomes like 5 trillion.
Yeah, because consensus, I guess it's for a reason, right? I was speaking to a few VC investors in Bay Area a couple weeks ago, and they're saying like some of them are kind of complaining that their bosses are just chasing logos rather than the differentiated bets. But I think in some ways, like you mentioned, if it's an open AI and it's still going to be the market leader, market winner, you're still going to come out on top, I guess.
Yeah.
Yeah. I want to hear, okay, taking a step back from these questions, I think from a cultural perspective, you worked in Silicon Valley, New York, and now like, you moved around in Greater Asia, Greater China. What do you think like differentiates the two ecosystems the most in terms of like the investment space and then maybe even just like some kind of high level work cultural tech space observations?
Yeah, I mean, there's a couple of things, right? So one is the abundance versus the scarcity of capital. And so in the US, there's still a relative abundance of capital where as an entrepreneur, it's comparatively easier to be funded versus a similar entrepreneur in Europe or Asia. And so and the other thing is you have capital at every stage, right? From seed through growth. And so the market as a whole has more shots on goal, more opportunity to experiment versus China, right? Where there is a comparatively or significantly less capital, especially US dollar funds in the past couple of years. And so on the investor side of things, they're also more risk off, right? Because for some of these Chinese VCs, they might not be able to raise another fund, right? So each shot on goal is a very heavy bet, right? Versus Andreessen, if you deploy like a fund very quickly, you could probably just raise another one very quickly as well. And so if, entrepreneurs can be more risk on in the US, investors can be more risk on, then one of these bets will pan out, and then that becomes the next like big company versus in China where you could raise less capital at lower valuations, less capital at growth. And I think where the domestic VCs might be extremely careful and maybe not having the same kind of venture power law mindset. I think that reflects on the products that you can build and the scope of ambition for entrepreneurs. And I think broadly, this is why more and more companies are trying to do the true high model, right? Where they might raise their first round of funding in China, but then quickly pivot to a Singapore or Canada or the United States, right? And then raising capital in the US.
Do you think it's like really affected the dynamics between investors and founders as well? Or do you think that relationship actually is still quite similar?
For the US, I think it's still an entrepreneur's market for the best entrepreneurs. Like, given the abundance of capital, that like has not really translated to kind of a linear increase in top founders. I think capital is still chasing founders every year, or taking a step back. There's a limited number of great founders per year that can build these generational companies. And so when AI investing becomes consensus and these founders tend to be in the US, then you have quite a bit of capital chasing these select founders. And then within China, like there's probably higher pricing or there's more power on the buy side, right? Where if you're one of the 10, 20 funds that still have dry powder at the early stages, or one of the 5 to 10 funds at the growth stages, then comparatively it's less competitive for the investor versus the US.
How do you think that's affected, I guess, this generation of AI entrepreneurs coming out of China? Because, like actually, if you look at the six dragons or four tigers, whatever you want to call them these days, like they're definitely nowhere as like valued as high as the American counterparts. They're a lot of them are actually finding funding from the BATs instead of, VCs. So like has this affected their future trajectory or the entrepreneur's mindset or their business model?
Yeah, I mean, I think it's all TBD based on, or TBD, like given the pace of innovation, right? So to our earlier conversation, like can one of these labs build something that's post-transformer, right? Or can one of these win in other modalities, right? Whether it's video or image or something else. But from a capital perspective, it's really hard to raise like another 2-3 billion, right, for any of these companies. And so like my hypothesis is some of these companies going public is a way for them to get another turn of the card, right? So it's like, hey, if we're able to raise 500 million, a billion on the kind of Hong Kong Stock Exchange, that gives us another 2 to 3 years, right, to figure things out versus OpenAI or Anthropic, where every round is heavily oversubscribed and they're able to basically chase everything, right? Chase CapEx, chase kind of their core products, as well as some of the moonshots, right? With OpenAI going into robotics, going into video, image, et cetera, et cetera. Obviously, maybe not to the same level of success as some of the other kind of image players or video players.
When we last spoke, you kind of made this like big statement thinking that eventually these Chinese companies will potentially be irrelevant or they'll stay within their ecosystem, right? It's a big statement. But I was kind of curious if you could like elaborate on that a bit more. Like I know you're very bullish on the American leaders right now, market leaders right now, but why can't a DeepSeek or a Moonshot, maybe do well globally as well? Or would Alibaba's open source eventually kind of, take on a leader role?
Yeah, so it's two things, right? I think it's capital and it's distribution. On the capital side, like we've talked about, assuming that model training inference follow the current trajectory, then it's a capital game. And so the companies that are able to generate the most revenues the fastest and is able to also raise the most capital will win, right? Under this kind of paradigm. And then secondly, even for companies like OpenAI, I think they realize that there's a limit to, for example, how much you could charge for APIs. And so they're definitely moving into applications, whether it's ChatGPT or something else. And that's where you can grab higher kind of margins than purely the API revenues. And then as you go into workflows, as you go into the replacement of human labor, as you take advantage of your initial tech advantage, to embed yourself into kind of the Fortune 500 clients. They're not going to kind of rip you out versus and then swap a potential Chinese competitor in, right? So I think the speed of distribution and how fast you're able to embed yourself into customer workflows where those customers have a very high likelihood to pay or a high willingness to pay. I think that's kind of the name of the game, right? So capital and then distribution.
Because you're basically saying monetization still has to be on the enterprise end. What about like China's AI like application on the consumer end? Do you see that being one of their advantages or something that they've done really well in terms of adoption rate? Like DeepSeek's hit like not DeepSeek, Double's hit more than 450 million MAU. DeepSeek even higher than that. It's kind of crazy in terms of scale. If you think about just like compared, it's almost comparable to the leading American applications right now.
Yeah, I think from a usage perspective, for sure. The more interesting thing is how do these companies and these products monetize? If we look at Alibaba, Tencent, uh, I guess like Baidu, ByteDance, and then even like some of the newer players like Xiaohongshu, right? How do they monetize? It's through ads, it's through e-commerce, and so I think for these new Chinese companies, it's figuring out how to monetize this chat interface, catering towards a Chinese audience. And I think the company that's able to figure it out, and it could be one of the giants, existing giants, they're gonna capture that slice of revenue. But as far as the willingness to pay for a Chinese consumer, I think that's significantly less than an equivalent US consumer where the number of people in China who are willing to pay $20 a month or $200 a month for kind of the higher tier of OpenAI, that's going to be limited. Right? So you have to win on scale, right? Scale of users, and then you have to win on these other potentially less obvious sources of monetization. Right? My guess is it's going to be advertising.
Yeah, it'll be like value added services or like
Yeah.
invisible ways of making money. It's not going to be like a subscription model or anything. I
Hmm.
agree with that. Yeah. Let's just actually double click on China. Bill Gurley, I think, has been one of the more, I wouldn't say pro China, but more outspoken investors in Silicon Valley that's not anti China, at least. I think he recently just talked about going to China as well, doing a big trip with his daughter. You wrote about Bill Gurley being wrong about China's open source models. Can you explain to the audience what was your whole thesis and why do you think he's not analyzing the space correctly?
Yeah, I mean, first off, like I think where he is right are a couple points, right? So the entrepreneurs, investors, folks in technology and finance definitely pay way more attention to the US ecosystem and learn from the US ecosystem way more than vice versa, right? And so that creates a huge blind spot for US entrepreneurs and investors. And then secondly, I think there's quite a vibrant and talent dense kind of ecosystem in China here as well. I think where he is maybe not where he might have like missed the mark. One is this kind of like grass is greener on the other side syndrome, right? Where a U.S. investor might feel like China is like the land of opportunity because of potentially lower valuations, because of very juan, right? Very competitive entrepreneurs, et cetera, et cetera. Whereas, and they might have this feeling that China is like kind of the buyer's market, right? Or the investor's market.
But wait, that was what happened with the internet era, right? So it's not like he has no basis with this mentality or thinking.
I think that's partially correct, right? So how does an American I guess like the question is like how does an American VC monetize this insight if they are potentially unable to invest in these underpriced but potentially competitive assets given some of the limitations for American investors. And then secondly, I think the open source closed source debate is like more interesting where at the found so I think Bill Gurley is a proponent of open source. And so the framework is like if you are a frontier lab and you are training models that cost tens or hundreds of millions of dollars per training run, you have to monetize it in some way. Right? And so if you are a lab that gives it away for free, that truly limits your ability to monetize. And that this is like very different from Facebook open sourcing their models because they have a very, very different business model than some of the labs here in China. So it goes back to even OpenAI and Anthropic, where initially they have the tech edge, right? They have the best models. Eventually, like folks are going to catch up. So they're really in this race to maintain being one of the top players, right? Top 2 to 3 players, and then winning distribution, right? So if you are at this Google scale as an OpenAI, where you have multiple software assets that people are using daily, and your model is, let's say, top 1 or 2 or 3, that becomes very, very hard to displace compared to a lab that only has a model but no product. And so I think that confluence of how do you build product on top of your model layer while you have the lead is really the name of the game versus, hey, I'm going to train a pretty good model and then I'm going to monetize via API and then just give it away for everyone else. I think that's probably not the winning game in this era.
Then what's the game that DeepSeek or Moonshot or any of these Moonshot that's behind Kimmy? What should be the game for them? I guess for them to be able to monetize eventually.
That's a great question. I don't know.
Yeah, I
Yeah.
think that's why, like for Baba, it made sense, right? It's kind of like the Meta Llama business model because end of the day they own distribution and they own the infrastructure. But like it's interesting to see because even the DeepSeek narrative, like oh he's a billionaire, he funds it himself, but then that's actually not that much money to fund. Like
Yeah.
we just talked about CapEx. It's like this is hundreds of billions. This guy's got $1 billion. Like there's still a pretty big gap in between that. He's not going to bankrupt himself to fund this, right? So it'll be
Yeah.
interesting to see how he monetizes or make this into something bigger.
Yeah, I mean the other thing is like the market is very dynamic, and for every one of these labs, you're one hit product away from monetizing, right? And I think it's never a wise thing to count a player out, especially if like a founder is very good and very thoughtful. And so if some of these like companies end up going public and raising, let's say they're a few hundred million or like $1 billion, they'll have another 3 years to figure out the monetization piece, right? But while they try to catch up in some model modality, right? So they might figure out, or Minimax might figure out, hey, like our video models are really good and truly world class, and we're going to build a bunch of these workflows and we're going to be adopted by the world, right? That could be kind of interesting as well.
It could be a business model that we haven't even seen before. It could be something completely innovative, right? Something completely new.
Yeah, potentially.
Yeah. Okay, I think I want to zoom out a little bit. When we talked, you said you are looking at Neoclouds, and this is a space where I frankly know very little about. So I want to hear from you, and please do explain things in layman terms and dumb it down for me. But alongside the hyperscalers, we're seeing Neocloud players like CoreWeave, Nebius like emerge, right? Like they're making headlines. How does the dynamic really work, like between the Neoclouds and our old traditional cloud players?
Yeah, I mean, so for some of these so defining neoclouds, like the way I think about it is it's GPU as a service, right? So whereas a traditional cloud provider like AWS or Azure or GCP, they might provide a bunch of services, right? So they might offer databases, they might offer compute, they might offer a bunch of these other pieces of software or storage. Neoclouds kind of simplify what they offer, and the core of what they do is they help companies with training models, doing inference on the models that they train. And so the dynamic so far has a couple dimensions, right? So if we look at the upstream, NVIDIA, right? So they basically supply GPUs to both the hyperscalers and the neoclouds. Their incentive is to have or to not have the hyperscalers be that big, right? Because they know that hyperscalers like Google, like AWS or Azure, they're building their own hardware. So NVIDIA is very incentivized to build credible competitors to hyperscalers where they reduce their customer concentration. And then for the neoclouds themselves, like a few of them were kind of in the crypto mining space before pivoting to kind of this like AI workflow, like AI compute. And I think the game they're trying to win is we have this wedge where NVIDIA will give us some allocation of their latest GPUs because of those dynamics that we talked about a couple minutes ago. And we're going to use this as a wedge to eventually become a really big player in the AI space, and maybe for the players with even grander ambitions to become kind of the next hyperscaler. And so you could look at like Oracle a few years ago, where their cloud business was a very, very distant fourth, right, in the US. But because of these recent contracts with these larger customers like OpenAI, that they're able to see significant appreciation in their market cap and kind of like exponential increase in their RPO remaining performance obligations because OpenAI is saying, hey, we're willing to spend a couple $100 billion on compute with you, right? Versus within Azure. I think the dynamic is hyperscalers trying to maintain their lead while trying to build more and more of their hardware in-house. And then on the Neocloud side, it's, hey, we have a wedge, right, with AI, a demand for AI, both on the training and inference side, and we're going to use that to grow our revenues very, very quickly, potentially take on a lot of debt, right, and then become kind of one of these large dominant players tomorrow.
So you said that, they're essentially like service providers. Could you actually elaborate a bit more on that in the sense that, again, this is really new to me, this whole sector, but people have said, oh, Neoclouds are a real estate business. Others saying it's a software layer value add service. Like, how do we actually see this? Like, can you explain that to me?
Yeah, so at its core, like neoclouds are just clouds with like GPUs, right? And so how do they monetize? And so there are basically three ways to monetize that we've been kind of diving a little bit deep into, right? So one is, hey, I am an OpenAI and I'm just gonna rent your GPUs, right? I'm gonna rent your infrastructure and I'm gonna do everything myself, right? And so for the neoclouds, that's kind of the lowest margin type business because you're basically taking some profit or taking some margin on top of your cost to provide that compute, right? So part of that is your initial cost to acquire that hardware. Part of it is your kind of ongoing electricity cost or cost to run the data center. And so that's kind of bucket number one of monetization for neoclouds. And then bucket number two is kind of the managed services, right? So if you want to provide software for training, if you want to provide software for experiment tracking, for A/B testing, things of that nature. So that gets you much closer to software margins, right? Traditional SaaS margins. And so I see more and more neoclouds going there, right? Nebius included, CoreWeave as well with their acquisition of weights and biases. And then the third part is what if we provide, excuse me, APIs as a service, right? What if we give you inference, we'll host the models ourselves, and then you just pay based on the tokens generated. And so that's like kind of the third category. And so how this space ends up playing out is what's the proportion of revenues that these neoclouds will be able to generate from each bucket of these services and products. Where if they're able to generate more and more revenues from kind of the bucket two and three, that makes neoclouds a much higher margin business than comparatively undifferentiated GPs as a service infrastructure. Although like running these data centers isn't that easy, and there's a lot of nuance between even some of these like more kind of leading edge cloud players.
I see, I see. I think I'm gonna actually ask you one last question on investment, which is I think energy is something that people have been talking about being affected by AI, obviously. And then like you said, software businesses, we're obviously already spoke about LLMs, etc. So what do you think is a sector that is gonna be affected by AI and you're looking at it as an AI investor, but are not as obvious to the public or not as obvious right now?
Yeah, I think that's hard. So just given most of our efforts are on the kind of public side of things, we are kind of looking at every layer of the stack, right? So from semiconductors, kind of the companies that build the underlying kind of infrastructure, right? So your transformer companies, your power companies, to your application companies. And I think it's more what's undervalued relative to kind of market consensus. And rewinding the clock back 1 or 2 months, Nebius was one of those players, right? And Oracle was one of these players. So it's more which player within which kind of layer of the sandwich is undervalued, and then how do we think about our risk adjusted returns, which is a little bit of a cop out answer, but our objective is to build a basket of these securities, right, across the stack, where we believe that these businesses will offer outsized returns. And going maybe a little bit deeper is for a lot of these businesses, they don't have kind of a pure exposure to AI. Meaning, even if you invest in a company like a Microsoft, right, or an Amazon, they have their traditional lines of businesses that you have to price, and then those tend to have, especially if they're more mature, those tend to have slower growth rates, right? So even if your AI revenues are exploding, they might be dragged down by some of these at scale, mature business units or products. And so, how do we think about the blended returns for, let's say, a much more or much kind of like traditional player in the kind of transformer space?
All right, Kevin, anything else you think you want to share with the audience, mindful of time or wrapping up our episode? Is there anything you want to talk about that I did not touch on?
Sure. I think a very interesting thought experiment is how fast AI will displace work. So I think like my perspective is it's going to be much slower than folks might think in Silicon Valley and much faster than the rest of the world thinks. Meaning, like next year, like 90% of the code is not going to be written by, or at least like code in production is not going to be written by AI, right? Or I don't see like broad swaths of workers get automated. But I think is AI adoption going to be a 20-year kind of journey? I think no. I think for a lot of these professions, it's going to be this like 5 to 10 year disruption. And then we're also already seeing some of this for new grad hires, right? Where a combination of AI giving more experienced workers higher leverage, as well as some of the broader macro headwinds in the US affecting kind of new grad job placements. And so I think my intuition is it's going to spill over to kind of the mid-level folks as well, right? Comparatively soon.
Yeah, I think actually I have an episode coming out literally today, which is with Diana Wu David. She's the director of features at ServiceNow. And she was saying kind of like instead of thinking about how it's going to displace jobs, it's going to change where the workforce will go towards. It's just that we need that time to kind of figure out where it's going. But like you said, right now, unfortunately, it's hitting the young junior staff the most because their work is usually, more, the hands-on kind of like the grunt work that is really easily done right now by AI. Anyway, thank you so much for your time today. I have one last question for you, which is a question I ask everyone. What is a view you hold that is unconventional or you think it's against consensus? It could be something related to investing or anything, in life.
I think something that's unconventional, especially folks within finance, I think folks in finance tend to be very sensitive to kind of market fluctuations as well as some of the macro headwinds or tailwinds. And so, especially right now, where I think we're in potentially a more challenging part of the cycle with employment, with kind of the degradation of kind of global connection. I think in the long run, collaboration will probably win out, or that at least that's my hope. And that bodes well for entrepreneurs, right, who want to play in multiple ecosystems. That bodes well for investors who want to play at these multiple ecosystems, right, across Asia, Europe, and North America. And I think the game is right now is especially for some of these venture firms in China is like who can survive, right? Because I think those that can survive and those who can continue to raise, they're going to be fine and they're going to see some very good vintages. And I think the same goes for when the US, right, also sees their down cycle. The folks that have a lot of dry powder who are able to deploy through those tougher periods, I think that's where you'll see good vintages as well. And so the question of like, given some of these like macro like headwinds, is it the death of the buy side in Asia? I think that's probably a little bit overblown. And like I think 5 years from now, 10 years from now, the ecosystem will be mature and healthy.
You think that USD denominated funds will see a revitalization? Or do you think
Maybe
we'll just see a complete different kind of ecosystem from 5, 10 years ago?
I think it either might be a completely different ecosystem or there's other global capital that's interested in the broader Asia ecosystem. And I think they'll come. It may not be at the same scale as the era of like 互联网, right? But like as long as the ecosystem continues to be vibrant, as long as entrepreneurs are able to build good products and generate or build large businesses, then there will be some capital somewhere in the world that's willing to back these entrepreneurs.
There's a lot of Middle Eastern money coming into China actually, and I think Southeast Asia family office
Hmm.
money and even I think European money, but it's definitely not the same scale as what we saw during the internet era with institutional US investors, right? But that's
Yeah,
encouraging. That's a positive note to end on.
yeah. Like I think like for some of these LPs, right, there's definitely a learning curve, right, in terms of LP sophistication and being very long-term oriented. Whereas some of these OG US LPs, they've had decades of experience investing in the VC asset class, right? And so when that learning curve catches up, then at least on the LP to GP side, we'll see some revival.
Great. Thank you so much, Kevin. Kevin Zhang, thank you.
Great, thank you.
If you enjoyed this conversation and found it insightful, please follow and subscribe to Differentiate Understanding on Spotify, YouTube, or wherever you get your podcasts. I'm Grace Shao, and thank you so much for listening. And I'll be so grateful if you shared an episode with a friend.